Good afternoon, everyone. Welcome to another one of our Wednesday market reviews. My name is Stockdarts, and as usual, we're going to go ahead and take a look at the four major markets. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish that, we'll take a quick look at the U.S. dollar, see how it's affecting gold, silver, and possibly oil, and then from there we'll move on to chart requests. If anyone has a chart request, feel free to put it into the chat tab, and I'll go ahead and get a chance to take a look at it as soon as I can. If you like what you see here today, you can always follow me at stockdarts on Twitter, where I basically post, anytime I'm going to post something, I'll usually mention it on Twitter. You can also find me on YouTube, and you can also visit me at patreon.com/stockdarts, where you'll find more content from me in the form of a lot of blog posts, usually little trade ideas or stocks that I'm watching, or just different industries or sectors that I'm trying to follow. And more often than not, if you like the content that you see here, you're going to like what you see at patreon.com. It's a little bit more specific to trading rather than just the markets overall, but it's a good place for you to go ahead and visit if you happen to like what we're streaming or what we do on the stream today. Other than that, let's go ahead and get started. What we're going to do first is take a look at the S&P 500. We had a nice move up last week on Friday, and so far the markets have held up pretty well over the last 2 or 3 days, or basically this week. And I think at this point, the markets are kind of ready to go ahead and re-challenge all-time highs in the pretty near future. We are in the beginning of a new earnings season. This week we have some financial names reporting, but next week we'll start to get a little bit more substance going and a lot more names reporting. And I think over the next 2 or 3 weeks, unless the flavor of the earnings season is bad, unless we get a lot of poor reports, I think that overall we're set up and we're poised to go ahead and start pushing forward and to try to break out to new highs on at least 3 of the 4 major market indices. Clearly the small caps aren't ready for that yet, but it looks like the S&P 500 and the NASDAQ and the Dow Jones are gunning for all-time highs. Now, are we ready to sort of rally past them and begin a new sort of longer-term rally? I'm not so sure about that yet. I think that for the most part we should expect to push and probe towards new highs, but until we see better participation out of the small caps, I think we're still going to be just sort of printing new nominal highs and kind of coming back and retesting and just sort of eking our way slowly higher as we continue to try to build up steam and try to get the small caps involved before we really break out. But I think things are looking pretty positive. They're looking a lot better than they did last week or the week before that. And that being said, they're looking a lot better than it did a couple of months ago. So overall, things are still improving in the markets, and I think that we're still heading towards the possibility of a nice rally towards the end of the year. And as of now, things are looking pretty good. So let's go ahead and take a look at the S&P 500 first with the ETF SPY and see where we stand and what's going on. So as you can see, on Friday we had a nice gap up. Now some of this was based off of, or the majority of that move was ostensibly because we came towards an initial trade agreement with China. And while I think news has a good reason for it, I think a lot of times the news is more of an excuse than a reason. Unless it's major news. And so I like the fact that we're able to push through there. Now, we did sell off in the afternoon, and as you can see, the candle's really not that great, but the important thing was that we crossed this 293 to 294 area, and we were right back above it, and that was a critical area on the S&P 500. And so I think at this point what it shows is the market is really ready to start trying to test new highs again. That was a pretty critical line in the sand that we were looking at in the short term, and really was sort of the switch between flipping between bullish or neutral. Now the flip between neutral and bearish I think was way down here around 280 to 277, and luckily we didn't come anywhere near that. We were able to hold above the 200 pair moving average and consolidate nicely after dropping, and we're able to make our way back up above that. And I think again this becomes the line in the sand. If you're still worried about what we're seeing in the market, if you don't think that we're really ready to go ahead and rally towards new highs, well, you have a nice level to go ahead and gauge where the market is, and that's this 293 to 290, well, basically 293 area. As long as we hold above it, and that's this green line here, as long as we hold above that, I think the market is looking for sellers and is trying to push towards new highs. As long as we don't fall below that. If we fall back below that, well then the market wasn't ready to push to new highs, and I think every time we cross below that line only makes it more likely that we're going to continue heading lower. So we don't really want to breach that line again, or that price level. What we want to see now is another extended push towards highs, and then hopefully a push towards new highs, and then we try to consolidate and hopefully consolidate above that for the next pullback, and then eventually push towards new highs. And so what I mean by that, and why this area is kind of important, is if we look at the weekly chart and we see the bigger picture where we stand, you can see that this area around 293 was kind of critical. Towards the middle of last year, it became the highs that we printed back in October or September of last year. And once we rolled over there, we had a really big sell-off. And we spent most of this year coming right back to that area. And you can see once we hit that area, we kind of pushed just above it, but then we eventually pulled back and had kind of our biggest retracement of the year. And then the next time we came through, we were actually able to build up enough steam to push out and break to new highs. And what we did now was we actually almost printed a double top, attempting to push past 302 to 303. But for now, we've had enough buy pressure to stave off that rollover and to come up and looks like we want to go ahead and test this 302 to 303 area. If you look again, what we're doing here, it's very similar. It's not quite the same, but it's very similar to what we did back in 2015 and 2016, where we spent a couple of years trading sideways. And that's really what we've done over the last 2 or 3 years. Is since basically the end of 2017 to about now, we've mostly just been trading sideways between about 250 and about 292 to 293. And over the course of the last 4 or 5 months, what we've been doing is consolidating at the very upper edges of that range and trying to confirm a breakout above it. And you can see we've held above that prior range for 2 or 3 weeks at a time a few times. And if we can finally maintain price action above that level and push towards new highs, we could end up seeing something similar to what we saw at the end of 2016, beginning of 2017, where the market just kind of took off and started running pretty much in a nice degree, nice 45-degree angle for almost an entire year. And that is kind of the hope here, is that we finally have spent enough time trading sideways and have built up enough momentum for the market to want to add another leg up to this historic rally that we've had over the last 10 years or so. And if that's the case, well, we're kind of right at the spot where we should begin to start pushing towards the highs and leaving behind the previous range. And I think that's really the key, is making sure that we stay above this prior 2-year range and build up enough momentum to no longer have to come back and test that. And so that's why I think that line, that 293 area is kind of critical, is because that was the ceiling of the range that we spent the last year and a half in, almost 2 years. And as long as we sort of hold above it and no longer come back and breach it on each sell-off at new highs, well, then it shows that the market is beginning to view that area as a value instead of as an area of supply and a potentially overpriced S&P 500. And so that's really what we're looking for, is for the attitude of buyers to change, where they now consider this a good place to buy rather than a good place to sell. And again, the ability to breach it last week and the ability to hold it over this week is a good sign, and it shows that we're beginning to see enough buyers to step in through there to go ahead and push again. So now the key becomes, of course, once we push up towards the new highs around 303, we want to sort of push past it, but if we don't push past it, I think the more important thing is that when we do retrace, we don't fall back below this 293 area. And if we can just stay above it and hold again for another month, then there's a good chance that as we roll into November and December, we'll have enough momentum to go ahead and push through it. And so that's kind of the key, and that's what we're looking for on the overall markets. And the S&P 500, I think, is the perfect picture of what the market is doing right now. Now, of course, the NASDAQ and the Dow Jones are trading very similar. We'll get to them in a second, but just wanted to point out that the idea here is that the market wants to push past the previous range, which the ceiling was 293, and find enough buyers to overcome the supply that is clearly here at 302 to 303. Each time we've come up and pushed new highs, we've been rejected pretty quickly, and we've had a pretty decent retracement through there. And as you can see, this last retracement, we found buyers a little bit more quickly than we did back in August and September. And so the hope now is that the next time we get pushed back, we find buyers even more quickly, and we find them above this 293 to 292 area. And if we do, then I think that only makes it more clear that we're ready to push to new highs. And at that point, we should be set up for a pretty good rally through the highs and into basically into the new year and through the holidays. Now, if we look at the Nasdaq, we'll see a similar picture, right? And this was pretty critical because, again, the Nasdaq was facing a nice convergence of possible resistance areas, and honestly, I didn't think we really had the momentum to be able to push through it after just one try. But like I said, last Friday we had good news, and that was able to propel the buyers to have enough confidence to push through. And as you can see with yesterday's action, and then just today we're kind of just having an inside day and kind of holding. But yesterday we had a really strong day, and you can see we're right there. We're just a hop and a skip away from all-time highs, and it's really not that far, and it's not that far-fetched to expect the Nasdaq to approach those highs and probably print even new ones within the next 2 or 3 days. And I would imagine by next Wednesday, more likely than not, we would have made at least one run towards that 195 to 196 area. And again, I think the key is not necessarily whether we could push to new highs when we come back and revisit that area. It's more along the lines of what happens if we find resistance again, if supply again overwhelms the buyers. When we pull back, do we hold above this 189? Or do we fall back and start to make our way back into this range that we spent August and September? And I think that's kind of the key. Each time that we've printed new highs this year, we've had a pretty decent retracement. You can see we printed new highs back here in May, and we had a pretty strong retracement. We retraced almost half of the move from the year. And then the next time we printed new highs, we didn't retrace all the way back to the June lows, but we did retrace a good portion of that move that we had. As a matter of fact, came back almost all the way down to retest the break of that last retracement. And if you'll notice again, the last time we came up, we didn't even print new highs, but we still retraced, but we continue to move forward, right? Each time that we have a retracement, the next time we find buyers is still a little bit higher than the previous time. So the market is still moving forward throughout the year. It's not going backwards. We haven't had a point yet where buyers have had to step in at a lower place than what they did the previous pivot. And so as long as that's the case, then the trend is still upwards, even if overall we're just trading sideways if you look at it from a 1 or 2 year perspective. But the key again is the next retracement hopefully maintains the same sort of trajectory, right? We pull back to 170, then we pull back to 179, and then we pull back to about 181, right? So if the next pullback is up to about 190, then I think things are great. Matter of fact, even if we come back, as long as we stay above 182 to 183, we're still fine. But ideally, I'd like to see us hold and above 189 to 190 on the Nasdaq, and then start to push forward. And if that's the case, and again, I think that the markets are aligning themselves for a good rally coming into the end of the year. Give me 1 second. All right, so that's what we're looking for, is for the next retracement to be smaller and more shallow than the last 2 or 3 that we've had when we come to new highs. And if that's the case, then like I said, I think that it's aligning ourselves for what could be a good rally into the close of the year. Now, of course, things can change, and we could have more news coming out of left field. It could be a poor earnings season, and if that's the case, then we have our warning lines, right? We know where we need to go ahead and change our stance on the market. If we start to lose this 189 level on the Nasdaq, if we start to fall back into this area, well, that's our first warning signal. Does that mean that we topped out? No, it just means that the market needs more time to chop around and trade sideways, and it just means that overall we're still trading in a neutral range. If you look at the Nasdaq, you can see even though we've been trading sideways, we have been making our way higher pretty steadily throughout the last year and a half, 2 years. So there's nothing to say we can't continue to kind of push higher. But if we do pull back, as long as we stay in the upper edges of this range, really there's nothing that has changed in the market substantially to go ahead and say that we're in a bearish market or we're rolling over or we're topping out. There's a lot of room to pull back before we really have to worry about a market that is indeed looking like it wants to top out. Theoretically, we could come all the way back to 154 and still just really be in a range-bound market. Now, of course, that would still do a lot of damage to a lot of portfolios and a lot of accounts, so we don't want to see that. But overall, in the bigger scheme of things, even if we come back down to that, it could just be indicative of a market that's range bound rather than a market that's topping out and sort of entering into a bear market. So keep that in mind. Always take a step back and look at the bigger picture before you jump to any conclusions on what's going on in the overall markets or even on any equity or chart that you're trading. If you're ever really unsure of what you're seeing on a chart, just dial it up a little bit or dial it back a little bit and look at a longer term time frame. And a lot of times you get a clear picture as to what's really going on with that chart. All right, so the key levels of the NASDAQ, again, I think are about 189 to 190. Obviously, all-time highs around 195 are critical. And again, I think the real key here is if we do breach 189, we shift to neutral. But I really wouldn't be too worried about a shift to the bearish side unless we start to lose maybe 178. Now, that being said, if we do lose 181, which is the last pivot, that would be a bad sign. And that would more likely than not mean that we're going to have to come back and test 178 at the very least. So you could keep that in mind as an intermediate level, and a level that if breached likely means that we're heading even further south. So that could be your early warning signal if we do indeed lose 189. But I think 189 right now is the critical level as far as knowing whether we're in a bullish market. For now, I think we are in a bullish market. Once again, I'm looking at long trades. If you were watching me last week, or if you watched the last couple of weeks, you'll know that we've been looking at short trades on Patreon, and I've been looking, and I think short trades were on the table when the market was kind of retracing, and even when it was trading sideways over the last month and a half, when it was back in August and September. But once we've flipped back over 189, I think that we're back to looking for bullish trades and looking for trades that are setting up for moves towards their recent highs, whether they're all-time highs or not. And I think that's kind of the area for me that's pretty critical is this. If we fall back below that, then I'll start looking at bearish trades. I'll start looking at more support trades. But as long as we start making our way back towards highs, I'm still going to be, at this point, I'm going to be looking for bullish trades. I'm still looking for range-bound trades because I still think that in the bigger scheme of things, I think we're still trading sideways. Again, if you look at the weekly chart, and if you don't want to, well, let's go to the monthly chart. I mean, the daily chart first. And what we're going to do here is if we just focus on what the market has done for the last 4 or 5 months now, it's just been trading sideways, right? So until we can actually push to new highs, the assumption is we're trading sideways. So I'm still looking at range-bound trades more than anything else. And what I mean by range-bound trades is that what I'm looking at is looking for stocks that are trading at support or stocks that I think I can sell premium on with options. You got a tough name there, Florinapexin 86 said. Thank you. I'm glad I'm glad you've been watching the channel. I appreciate the compliment. I'm glad that you like what you see. I appreciate it. Let me know. Yeah, I'll see what you could do for me. I used to be a graphic designer, so I've actually designed stuff in the past, but nothing wrong with collaborating. So if you have stuff for me, cool. I'd love to see what you have. Okay? Thank you. All right, so to go back to what we're seeing. So you can see we're trading sideways, right? So in this particular case, there are two things I want to point out. One, again, I think we're in a more bullish market, so it's okay to trade to the long side. But two, keep in mind, we have resistance right overhead, right? So you don't want to get too excited about buying into highs. You want to make sure that there is good risk and reward here, right? And that the names that you're looking to trade offer you the right setups. You don't want to buy, or you don't want to chase price action into highs. You want to make sure that you're buying stocks that are giving you good risk reward, that are still towards support areas or are emerging from consolidation patterns. And I think that's really the key is, for those that maybe are new here, what we typically do in these Wednesday market streams is we try to identify what kind of market we're in, because that gives us a better idea of what types of trades we should be searching for that match the market behavior. And so in this particular case, I think we're back in a pretty good bullish environment, so you want to trade to the long side, but I also think we're still in a neutral environment, which means you want to go ahead and take advantage of range-bound types of trades or behaviors. And that means If a stock is approaching resistance, you look at covering it or selling, selling covered calls or taking profits. And if a stock is approaching the bottom of the range, you look at possibly buying it and trading it for the bounce. Or if you have the ability to, you go ahead and take advantage by selling premium on options, which is really what we've been doing over the last 2 or 3 weeks, is taking advantage of options premium by either selling put spreads or taking calendar spreads or selling call spreads, depending on what side of the coin we are on, depending on where we are on the markets. Even iron condors have worked out great recently. So that's kind of the idea of what kind of range bound strategies we want to look at. All right, so if we move on to the Dow Jones, we'll see again a very similar pattern to what we saw in the NASDAQ and what we saw on the S&P 500. We had this area here around 265, which is kind of the critical zone, and you can see we were building up pressure to break through it. Very reminiscent to what we just saw in the NASDAQ, right? We had this ascending triangle. We had this convergence of resistance levels, and we were able to just gap right through it. And so once we gap through all that, we gap through this 265, 266, we gap through this ascending trend, all of a sudden we're in a market that's above all of these potential levels of supply or distribution. And at this point, the next level of supply or distribution, or the next level, the next area where sellers will be really prevalent, is going to be all the way up at highs around 274. So there is room for us to continue to push forward. Now, that being said, we have been green 4 days in a row, well, actually 5, and really about 7 or 8 out of the last 10 days, right? So the market could need a little bit more time to kind of consolidate before it pushes to new highs. Risk reward again is not that great if you're just trying to buy the Dow Jones, or you're trying to buy any of these indices. As you can see, we've got a room up to about 274. We also got downside all the way back down to about 265, so about 5 points in either direction. So the key is, again, looking for names that aren't in the same spot. What we can figure out from this is that the market is bullish again, but we still have to find the right timing setups and the right risk-reward setups. Riri's house, you've been scalping TVIX. Any thoughts on that? Yeah, I'll take a look at TVIX and the VIX once we conclude the 4 markets, and then I'll look at it real quick before we move on to the U.S. dollar, okay? And good to have you back in here. By the way, am I saying it right? It's Riri, right? Not Rai. Hope I'm saying it right, but I'll take a look at it and we'll see. So the Dow Jones, again, very similar to the S&P 500 and the NASDAQ. Again, the analysis is almost the same for those three, because those three indices are all marching in order. They're all marching in unison and basically to the same tune. So there's not a lot that I can add to the Dow Jones that I haven't already said with the S&P 500 and the NASDAQ. This 265 is the important level for us now as far as short-term bullishness, or whether we need to step back and look at a more neutral environment. And again, I think if we come back down to 254, I think that's the area where we would have to really reassess where we stand and look at a more bearish market. Now, that being said, just like the NASDAQ, we do have our most recent pivot, which comes down to about 257. So if we lost that, we'd likely come back to 255 on the same day or the day right after. So that's the early warning signal. If we come back to that level, there's problems to be had. But for now, the real area that we want to watch is this 265 area. As long as we stay above that, again, the market is looking upwards and is looking for where sellers are, basically. And I think right now that's where we stand. Now, we could come back and retest this zone again, and if we do, as long as we hold above it, I think that sets up for a really nice bounce play and a move back towards recent highs. So I think overall, if you look at these three indices, it's all bullish, and I don't think that there's anything bearish about it. Not saying we can't pull back from here, but if we do pull back, we know exactly where we want to stay above, and as long as we stay above that, we're fine. If we pull back below that, hopefully it's just a shakeout candle and it comes right back. But if we end up sustaining price action back below these levels, well, then we know the market wasn't ready for it, and that means more likely than not the market is going to push even lower and really test where the bulls are hiding, if there weren't enough bulls to hold this price action above this area. But I think for now, as long as it's holding above that, I'm bullish, and I'm going to be looking for plays to the long side that go ahead and take advantage of that. All right, so last up we have the small caps, and the small caps are not in the same place at all. Uh, as you can see, the small caps are still really towards the bottom of their range. If we go ahead and go back to the weekly chart and take a look at what's going on over the last couple of years, you can see where we stand on the small caps, and really it's not that great. And so this again is, for those of you that are here regularly now, you'll know that in my mind this is indicative of a market that has a lot of fear in it, despite the fact that it's bullish. So we have this strange dichotomy in the market where you have a pretty bullish stance and you have a lot of aggressiveness, but yet you still have a lot of hesitance and a lot of fear because traders are still avoiding the most volatile assets, which are the small caps. And typically, this is where you get the most return when a market is doing well, is the volatile assets, which again are the small caps. They tend to be the ones that move the strongest in either direction. So the fact that we're not getting full participation in the small caps shows us that traders still have one foot out the door as far as this market's concerned. As soon as there's any signs of potential weakness, the first place they abandon is the small caps, and that's why IWM has had a real hard time being able to keep up with the other three indices. I personally think that in order for us to have a really strong rally, we need to get back above 158 on IWM. You can see that's still pretty far away. So there's a lot of catch-up to be had here. Now, does that mean that I'm bearish on the market? No. What I think this means is, as long as IWM is lagging this bad, or this is trading this poorly, I think it means that the overall markets are still trading sideways. Because of that, I'm still employing range-bound strategies, despite the fact that we're near all-time highs on 3 of the 4 indices. I still think that we need more time for the IWM to catch up. And I don't need IWM at new all-time highs. I just need it to push past this level that has held it in check all year. You can see every time that we've come up to 158 on IWM, we've been rejected pretty quickly. And all 3 of these, or all 4 of these, have basically coincided with the market being rejected at highs. And so what we want to see is this next time, we want to see the price action get back to that level and hopefully sustain it and be able to break through it. And I think if that happens, then I think it's all systems go. And I think at that point, the market will be trading in a much better place and will be marching relentlessly higher. Until then, I think we're going to continue to doing the same thing, which is we might print new highs, but we're not going to really continue to march past them. We're just going to kind of push new highs and then retrace and then chop around for a bit and then maybe try to push again. But we won't have a really strong trend unless IWM falls in line and starts to break through these levels. Now, again, that's my personal opinion, but that's what I'm seeing, and that's kind of what I take out of IWM. Now, I don't think that we have the same key levels that we could judge IWM as the other 3 indices. I think as long as we're holding above the lows, we're okay. But as long as we're not trading above these recent highs, we're not really in that great of a place, right? And so we're right back towards the middle of that range. You can see we're at 152, so we've got about 6 points to the upside and about 7 to 8 points to the downside. We're kind of right in the middle, and we need to break through this glut of moving averages that are all just kind of coiling around. And if that's the case, then we can make up some ground here and ideally build up enough pressure to start to go through there. Now, as you can see, there's a lot of room here to the upside before we get to significant resistance. So it could be IWM continues to climb. I think that we're probably going to consolidate for a few days at this level and then maybe try to push past that. But don't put it past IWM to consolidate here and then fail and come back. And if that's the case, it might coincide with the markets coming back and retesting their recent breakout over those green lines. And if that's the case, what we want to see out of IWM is we don't want it to fall back to 144. We want it to maybe maintain price action above 147, 148, and at least build up some momentum here to continue climbing higher. As you saw in the other 3 indices, we never went backwards. Every time we pivoted, we would find a pivot. The next pivot was a little bit higher. IWM has not been the same. Matter of fact, every time that we've come back, we've tested the same level, which is this 145 to 144. The first time we did it in June, we came to 145.50 or so. And then the last time in August and September, we actually breached it and came a little bit below it. And then recently, we came back and we almost tested the same exact level, missed it by a few pennies, but for the most part, you can see that we are nowhere near the same sort of strength as the other 3 indices. And I think until we see a change in that, we have to assume that the market is going to continue to exhibit range-bound behaviors and is going to continue to chop around and fool traders. Now, it doesn't mean, again, that we can't push these new highs. It just means that those highs are likely not going to be sustained for a long period of time, which means be careful and don't chase price action. All right, so that's the four major markets. I think overall, I'm going to continue to trade bullishly, and more than anything, I'm going to employ range-bound strategies. Now, that being said, we are in earnings season, and during earnings season, I tend to focus on earnings trades which aren't correlated to the market at all. I like to use options to go ahead and trade volatility during earnings events. I think it's a very predictable way of trading earnings, and it's a lot better than trading a stock directionally during those events. If you're interested in those types of trades, I'll likely be sharing a few of them on my Patreon blog. So feel free to visit that if you want to go ahead and see some of those types of trades. Most of the time they'll be for members, but a lot of times what I'll do is they'll become free to view for everyone after a few days. So if you don't feel like paying the $8 to be a member, then you can see the trades after the fact and see what they did. But for those of you that are members, keep an eye out, because I'll likely share a couple if they present themselves. I'm not going to just throw out trades if they're not great, and that's one of the issues I've had over the last month or two is I haven't seen a lot of good trades in the market, and when that's the case, I tend to trade a little bit more lightly and a little bit less, a little bit more rarely, and so I don't have a lot, that many trades to share. But if the opportunities present themselves, I will be sharing some earnings trades this quarter to give you guys an idea of how I go ahead and take advantage of earnings behavior. With that being said, before I move on to the U.S. dollar, let's take a quick look at TVIX. For Riri's house. All right, and so as you can see, had a pretty big drop on, and so this is a double. This is basically a double VIX chart, right? Let's take a look at the. Let's just look at the VIX first. Let's see where we can see. You can see when the market's doing well, the VIX is going to be low. That tends to be the case. And as you can see, we're kind of coming into some lower levels of VIX. I hesitate to use technical analysis on the VIX because it's not an instrument that has supply and demand. It's really just it's kind of a mathematical formula that tells you what traders are thinking. But as you can see, we're starting to approach lower levels of volatility, especially for 2018. If you look at 2018, typically the lower levels have been here around 11 to 10. So we still got a little bit of room for the VIX to calm down a little bit. But overall, we're starting to go towards the lower edges. And again, I think VIX, like anything else, likes to revert to the mean quite a bit. So you say you've been scalping TVIX. Have you been scalping it? Do you mean like day trade scalps, or do you mean like quick swing trade scalps? I'm assuming you mean day trade scalps. And if that's the case, it's not a lot I could really offer you from here. But let me know what exactly you're looking for as far as you bought on open and sold today. So you're basically, so for the most part, you're trading it. It's almost like you're day trading the market, but you're doing it through a different instrument. So if we can see on a 5-minute chart, you bought on open. So basically, you thought that there was a good chance. Well, at the open. So yeah, basically the inverse of SPY. So you're just using a different instrument to go ahead and trade the markets. And the good thing about this is for traders with accounts that maybe aren't that big, and you don't want to, or if you want to leverage more, and you don't want to buy. So we're looking at the S&P 500, right? If you're looking at SPY, you're looking at $200, $300 a share, right? So that's going to be a lot more investment involved if you want to go ahead and take a lot of shares of this. Now, especially if you're day trading, right? Because when you're day trading, you can leverage up a bit more because you can have pretty tight stops. Now, in the end, really, the price of a stock shouldn't make a difference, because you should just, whether you're trading $1,000 of capital or $3,000 of capital or whatever it is, if $10,000, it just means less shares of this and more shares of something else. So it really shouldn't make a difference, but it does. Despite that, a lot of times it does make a difference. And so TVIX being only $10 a share, $11 a share, it could be, you could be more comfortable trading 100 shares of this as opposed to 2 shares or 1 share of the S&P 500. And so basically, it trades the inverse of the market. So you're just using it as an inverse of that. And I think this is a good point for any of you guys that are taking trades like this, or maybe don't realize it, is when you trade something like this, you're just trading the market. You're using a different instrument, but you're trading the market. And it's important to keep that in mind, because in this case, if I were trading this, I wouldn't look at this chart at all other than to figure out my price levels. I'd look at the market, and I would keep an eye on what I consider to be the pullbacks in the market. So in this case, you bought on open, so you expected the market to fade. It did not. It actually, obviously, came back on you. So I'm assuming if you bought at the open, you bought probably close to the highs, right? I mean, I'm assuming if you bought open, you bought the first candle, and that was probably a mistake. And obviously, you had to have stopped out. Well, 1023. I don't even see it at 1023 today. Is my price different from yours? You mean maybe 1123? 1123. Okay. Oh, okay. So maybe you got okay then. You were in at 10.1. Okay, so you waited. So you didn't wait. 10.1. You mean 11.1? Right. 11.1 and 11. Okay, so all right. So you basically waited for the fade, and then you were able to buy, which again is sort of like the S&P 500 broke out, and then you played the first pullback. So here's what I want to say about that. I don't think that there's much I could tell you about the TVIX. That doesn't make, it's the same as trading. But what I will point out is when you're day trading like this, so I just give you a little bit of a, the way I like to approach day trading in general. There's one strategy that you want to look at is the opening range. And the opening range breakout. So you want to do is identify what the opening range on the day is, right? And today was a little tricky because it didn't really offer a defined range, but you could say that this was the opening range. And so ideally what you want to do in this scenario is once you figure out what the range for the open is, once it's breached in one direction, that usually gives you a good idea of what the market wants to do. And in this particular case, you can see we kind of opened and then we pulled back a bit, and then once we were able to push past that range again, that typically means that you're going to have a nice move up through that. If it kind of came back to the bottom, then you could have played the bottom of the opening range and tried to trade it that way. And so that's one thing I look at, is not necessarily the opening candle, but maybe the opening half hour to hour. And then try to gauge what's going to happen from there, and then that'll give me a good idea as to how it wants to break out. You look for volume. The problem with volume at the open is that it's always going to be high at the open. It's always high first 60 to 90 minutes because you're going to have a lot of positioning. Now you're saying it's higher every day, last 4 or 5 days. I don't know. I mean, maybe, but that's harder for me to gauge if opening volume has been higher. I haven't paid attention to that, so I don't really want to say yes or no. But that happens a lot. And by the way, that happens a lot. That happens all the time, by the way. For anyone that's not really sure about volume and how it works, there's always a lot of volume at the open and a lot of volume at the close. That's like standard. If you look at a typical day, you're always going to have high volume at the open and high volume at the close. Now, some days you're going to have big volume spikes like this. That's not normal. More often than not, you'll get a big volume spike. Then if there's a big move on a news event, which is what happened there, and then at the close, you typically tend to get more volume again. And it tends to go that way. And so a lot of times when you're trading, you have to understand, that's why they say the lunch, don't trade during lunch, or, don't trust moves during lunch. But when you're day trading and when you're scalping like that, I think a lot of times the opening range gives you a good indication of how the rest of the day is going to be. I'm usually if I day trade, I avoid the first half hour or so, because I trade a lot with trend lines, and so it's hard for me to to get a good gauge or good feel for the day, unless I have something telling me what traders are thinking, and that's why sometimes I use that opening range, or if not, I'll wait for some trend lines and start to gauge exactly what the market wants to do, and then go from there. And so that's another hint that I'll do. And I think volume is important. I like that you're looking at volume. I think volume gives you good clues during daytime trading. But I can't say whether it's higher than if the last 4 or 5 days have been higher than before. I haven't been watching, so I can't tell you for sure. But hopefully that helps you. We took a little quick side turn here, but hopefully what I saw helped. I can't really give you much with TVIX scalps because honestly, any instrument that you're trading would have been the same thing. But my thoughts on what you were doing today, it looks like you weren't expecting the market to be as strong as it was, but you were able to get out a quick profit, so that was good. But as you can see, the market did climb pretty good, and while the TVIX didn't return as much, you did catch, I guess, that little bounce. I'm assuming that's where it was, right? 11 to 11.20, and so the last thought I want to give on this, I don't want to spend too much time here, but I find that a lot of times mean reversion works pretty well during scalping and day trading, and obviously that's what you were doing, was you had the strong move and you were playing the mean reversion, and I tend to agree with that. I think mean reversion and trying to catch counter moves is usually the way to go, unless you have a strong trend day. And usually strong trend days are pretty difficult for me to trade because of that, because I try to counter trend. But more often than not, I find that the plain mean reversion on scalping tends to work better than trying to catch trends. Okay. All right. So hope that helps, Riri. I know that I didn't mention a lot about the TVIX, but I don't think there's a lot to point out here because really it's just like you said, it's just an inverse chart of the S&P 500. Let's take a look at the U.S. dollar. As you can see, the U.S. dollar has actually lost a lot of ground over the last 4 or 5 days. And again, this is basically because of the euro. If we look at the euro cross, I don't know. To tell you the truth, I'm more of a technicals trader than a fundamentals trader. So a lot of times, I don't want to just sit here and give you an answer because you're asking. I don't think that my answer is going to mean anything, honestly. I don't spend a lot of time thinking that deeply into fundamentals, so I don't want to just pretend that I have an answer if I don't. I don't know what would happen. As you know, a lot of times with these big macro news events, just because something theoretically is supposed to happen, it doesn't always happen. You can see the Fed lower interest rates and then we'll still go up. You can see a trade war thing where we have where it's supposed to lead to a drop or a move, and then it goes the opposite direction because it's to sell the news. So I'm not really sure what's going to happen with the Hong Kong bill and what happens if it does pass, or what kind of issues are going to arise in our markets with it. But I don't know. I'm not gonna. I like it. That's something that I don't want to pretend I have an answer if I don't. So back to the euro US dollar. As you can see, the euro picked up a lot of steam today and is moving higher. And I think that this is a good move for the euro because it finally broke this strong downtrend and is starting to make up ground now. Do I think the euro is going to rally and make its way much higher? No. I think more than anything, the euro is going to probably stay range bound here. But the important thing is that it looks like it's found a bottom. And I think that's pretty important. I think that's going to have implications for gold and silver in the near future. Although up to now, for some reason, it hasn't really been the case. But I think it will have an impact in the near future. Now, even though the euro is, and again, by the way, for those that maybe aren't sure, this chart down is good for the US dollar, up is good for the euro because this is priced in euros. And so in this particular case, the euro is moving higher, which is good for the euro and bad for the US dollar. And I think that is why we're seeing the US dollar lose some ground here and start to pull back. Okay. Now, if we look at the US dollar versus the Canadian, you'll see that the U.S. dollar is actually struggling versus the Canadian, and it's basically range bound. So a lot of what we're seeing on the UUP index as an aggregate, the U.S. dollar as an aggregate, is strength versus the euro, not necessarily versus the Canadian or versus other currencies. Typically, I like to look at the U.S. versus the Canadian and the U.S. versus the yen as the other two crosses that I like to kind of follow. And while the U.S. dollar has picked up strength versus the yen, as you can see, it's not really that much better than what we're seeing out of the Canadian. Now, that being said, we do have a nice inverse head and shoulders here, and so there's a good chance that the U.S. dollar has now found or formed a very stable bottom versus the yen. And if that's the case, we have a pretty good potential move upwards coming soon if the U.S. dollar can sustain this breakout and push through this level, this 108 to about 109 level. So there is a chance that the U.S. dollar rallies strongly versus the yen in the near future. Now, it's been up quite a few days in a row, so there's a chance it needs to consolidate here. But if it could build up pressure and push past that, that could bode well for the U.S. dollar, and that might even have implications on the U.S. dollar as an aggregate on the UUP index. Now, with that being said, again, I think that because the euro has stabilized and has formed the bottom against the U.S. dollar, that's going to hold the U.S. dollar in check as far as the overall, as an aggregate, just its value. And if we start to see the UUP index start to degrade a little bit more and start to erode and lose a little bit more value, I think that bodes well for gold and silver, although we haven't really seen that yet. If you look at GLD, you can see that at the moment it's still struggling to kind of maintain this price action around 140. But I think that it's found support, and as long as we see the U.S. dollar continue to hold at its current levels or lose more ground, it should eventually reflect in gold prices, and we should see a bounce in gold. Now, gold is still range bound. I think gold is still within this larger pattern and is still trying to push through that, so it's going to be a messy trade to try to catch it to go through here. But I think that it's okay, and I think that there's a shot. And for those of you that follow me on Patreon, you'll know I put up a post yesterday on possible gold trades, and it's a free post, by the way, so anybody could look at it. And I think that there's a chance that we see gold and silver prices shoot up in the near future, but for now it's not really participating as strongly as I expected it to. But if we continue to see the euro build up pressure versus the U.S. dollar, and as long as the dollar doesn't rally strongly versus the euro, I think that's going to alleviate a lot of the pressure on gold and silver, and should eventually lead to a higher move in the precious metals. And at the very least, get them to come up and start testing their previous levels of resistance and start, just testing the upper ranges or the upper edges of the ranges that they've been kind of stuck in. And then finally, the last thing we have is oil. And as you can see with oil, it's been struggling. It did find support here around 51 and is trying to make its way back higher, but it's really struggling. Wes, I don't know if Wes is in here. You had asked me before about oil a couple of weeks ago, and I think you got a small bounce on it. I believe you were looking at UCO. And you were able to get a little bit of a bounce off of it after that level of support. But, hey, Wes, good to see you. Are you still trying to trade this, or did you give up on this trade? You probably got a small bounce because the timing was still good. You had good levels of support on it. But overall, we haven't seen a strong enough bounce in. If you got into that trade, you probably should have closed 3 days ago. We had this nice attempt at a bottom. You didn't take the trade. Okay, good. It really wasn't that. It really wasn't that clear of a bounce. So it's good that you're being patient. Now, there was a bounce, obviously, because it was a good level of support. And we got this bull flag that eventually turned into kind of a base. But with the drop that we had on Monday, I think it was clear that oil's not ready to really push higher yet. And we're kind of right back in the same little bear flag. And I think more likely than not, oil is going to try to push its way back towards the mid-50s. But for now, it's just stuck in it's in a big neutral range, and it's really struggling to try to push higher. And at the moment, I don't see much that is really indicating oil to push through that level, or to get a little bit past that. All right, so that's oil, gold, and silver. For the most part, I don't see a lot of opportunities on oil right now. I don't want to trade it bearish or bullish right now. I think it's in kind of a messy area, and really nowhere to go from there. Um, we have about 10 minutes. If anyone has a chart request, feel free to put it in, and I'll take a look at it. Um, while we do that, I'm just gonna Riri, with the Hong Kong bill, you're talking about the extradition bill, right? Or is there something different that that I'm not looking at? And so my thoughts are the only really the most interesting thing to me about that. I'm assuming that's the extradition bill. To me, the biggest thing is the big shakeup it's had with the NBA and with just news in general, and how a lot of professional athletes have caved in under pressure because they'll take a hit financially. Let me know if that's what you're talking about, or if there's something else economically that's going along with what they're doing. I don't know what to make with Brexit. It's been going on for so long now, um, and I've I've often wondered if that has anything to do with what's been going on with the U.S. dollar. But with the euro versus the U.S. and if this a lot of this weakness has been because of Brexit, I really don't know. Like I said, I don't pay that much attention to fundamentals because I feel like there's too much information out there that I'm not privy to really make a good judgment. That's why I tend to look at price behavior, um, but I don't really know. So the BCS moved up on possible deal. Um, I don't know. So Barclays, no, this is not it, right? Um, what's the British sterling again? It's Great British Pound, right? Is that what you're looking at? The Great British Pound versus the U.S. Yeah, we have time, Riri, to look at XLE and XLF. So, Riri, just out of curiosity, do you follow the NBA? Is that where have you been paying attention to the whole thing with Daryl Morey and everything that's been going on? Is that where you thought about it? Also, you've been playing Barclays. Okay, so you've been playing Barclays. So let's look at Barclays first. Sorry. So we'll look at the over the counter. Well, I can't get this chart. This is not going to work. So we'll look at XLE and XLF. Um, yeah, Riri. So I'm a pretty big NBA fan, and I will say not anything to do with trading because I don't know what impact if any it would have, but um, as far as just my thoughts on that, I thought I like that Adam Silver defended this his right to free speech. I thought that the Rockets really caved into pressure. I didn't really like that they actually were thinking about firing him. I thought that was pretty lame. And I also thought that Steve Kerr and not Popovich as much, but Steve Kerr kind of copped out on it. And I think LeBron really copped out with his messages recently. So, those are my opinions. I think LeBron, I lost a lot of respect for him trying to criticize Morey, and when LeBron really didn't know what he was talking about. Uh, and I thought I thought that was a really in poor taste by him, and kind of made him look bad, as he was basically just trying to protect himself and protect his financial interests. And in the end, it kind of backfired on him anyway because he wasn't strong enough about his support of China. But yeah, so my thoughts on it. It's not related to trading, of course, but in general, I think that a lot of these a lot of these athletes that are so quick to condemn things that are going on domestically, and then they won't condemn some of the real problems that happen overseas because it's going to cost them money. And I think that that's pretty, it's in poor taste in my opinion. So looking at XLE, well, all right. So Not really seeing a lot. I think energy, a lot of times XLE is going to behave very similar to oil. And I think that's going to be part of the problem I'm having with this chart is that I'm not really excited about what I'm seeing here. So I think in general, and by the way, this is exactly what I mean. When I look at a chart, if I don't really get a good vibe as to what I'm seeing, I'll dial back. I'll look at the weekly, and if I don't even like that, I'll go to the monthly. But always look at the larger time frame until you get a clear picture of what's going on. And so now that we get to the monthly chart, we get a better idea of what exactly is going on with XLE. Um, so you can see this right around 57 or so. It could be, it could go up or down. The truth of the matter is that a lot of times these ranges are not just one specific trend line, so it's not 57.57 that's important. What's important is the $57 range, right? So it's really more like, oops. It's really more like that, right? So in general, 57 or so has been a good support level for XLE. So it's a good support, or it's close to good support. We go to the daily. You can see it just bounced off of that range and it came up and it's consolidating right above it. So it could theoretically be a good level to buy. I don't like this. If we zoom in, you see these longer wicks as we've kind of tried to push higher. So it's encountering a lot of selling pressure here. And I think ideally now what we want to see is we want to see if it finds support around 57.40 and then push back through. And once it could push through these wicks, it will show that the buyers have overcome that. And then at that point, we have a good move probably about to 59.70, 59.80. And then from there, maybe it can make its way back up to the 60s. But for now, that's what I would look at. Just watch to see if it overcome all the selling pressure of the last 3 or 4 days. And if it can, then we can make a move up to about 59.50 and then possibly all the way up to about 62. And those will be the targets. But clearly at this point, you have to be a little bit stingy with your stop. You can't stop out all the way down here at 55 unless you're kind of holding it for the long term. So I'd kind of play that level. I'd play this level here as support. And then ideally, I would play the breakout through here and look for about a point or two of upside. Now XLF is interesting because we have a lot of banks that are reporting earnings this week and next week. If we go to actually this thing's going to be giving me some trouble here, but if we look at so like Wells Fargo just reported, right? Citibank just reported. Bank of America reports, or just reported today. Next earnings date, October 16th. So I think they reported today as well. So we have a lot of banks reporting this week, right? And depending on how they all go, we'll get a better picture of what's going to happen with XLF. For the most part, it's kind of stuck in neutral, really. We had this downtrend, right? And we had the drop, and we've kind of come right back up. And I would say at the moment, what we're doing is so these trend lines, a lot of times you'll have a break, right? So you have a trend line, and then you have a move past it, and that breakout level becomes an important level as a retest, right? So you can see we broke out, and eventually we came back and we retested this price point and failed, and then that became a level of resistance that the market or that the financials struggled with, right? Well, it works on the other side as well. If you have a trend line like this, you have a consolidation range, and you fail, then that becomes a critical level for you to come back and retest and try to push through. And that's where we are, and that's what we're stuck at right now with the financials. Is we had that drop, and it was a pretty significant drop, and they've made their way right back, and now they're struggling to push past that. Um, I think in order for the financials to be a good trade, we want to see what happens through the rest of this week, and once we digest all of the earnings from most of the financial names, then we'll see whether they could break out. Now, as you can see, they're lagging the markets in general, right? Um, because if you look at where the all-time highs on it are and what it's been doing over the last couple of years, it's not quite as bad as IWM, but it's certainly not as good as, say, what the S&P 500 is doing, right? Um, you look at where the S&P 500 is, the price action compared to what we've done the last couple of years, and you go back to the financials, and you can see that they're not quite in the same place. So they've been struggling, and they're not really ready to kind of push back. And truth be told, there's a pretty decent level of resistance, kind of just above us. So I don't know that I'm that excited about XLF right now. Were you looking at either of these as potential trades that you're also scalping like during the day, or are you looking at these as possible swing trades that you think could be worth something in the next week or two? Okay, so swing types of swing trades. Okay, so um, I think I like the risk reward better on XLE, even though XLE is clearly a weaker chart, because at least with XLE you have a these stable areas and you have upside. I think the problem with XLF right now is that even if we do get a move up from here, there's going to be really strong resistance 50 cents away. And if you really think about it, there's not really a good support area that you could define as a good stop out point if you tried to take a trade at this level. So I think theoretically the only way that you could really take a trade on XLF right now with good risk reward would be if it formed a bull flag and then you traded the momentum, and that's probably a few days away before it even would set up, and it would have to set up perfectly, and then from there you can manufacture. If this happens ideally, then you could try to take a trade up to 28.50 with a stop of maybe 10 or 20 cents depending on how it formed. But if not, at the moment I don't think that the risk reward is here for XLF at all, because again, with what we're seeing right now, you really can't buy it until it breaks past 28. And if you do, what do you got? You got 50 cents of upside, but where's your downside? Um, that's about right for me too. Usually when I take a swing, it's about it could be as quick as 1 or 2 days to about 3 weeks. Yeah, that's cool. So yeah, so those are my thoughts. I think of the two, I prefer XLE. I think it's a lot like oil in that we found some support and now it's trying to stabilize and push past that. And there is limited upside, but I think there is upside compared to what we're seeing in some of the other ones. All right, so that covers it for today. I appreciate the participation and the attendance. Those of you guys that added input, I really appreciate it. I think it makes this way more interesting if we have more stuff to talk about than me just babbling on about the market. So I appreciate you guys that attended, and I appreciate particularly the ones that actually gave me some content. But anyone that came in, if you were too shy to ask a question, you can always ask me. You can either ask me on Twitter, or you can follow me on. You can go to our Discord chat and ask me there, or you can even just email me stockdarts@gmail. I'd be more than happy to help you out and give you any advice that you need. But if you want, you can just message me on Twitter, and it's just the same, and I'll send you a chart and give you my thoughts on any chart throughout the week. Other than that, I hope you guys have a good rest of this week, and we will meet again next Wednesday.